Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to break-even analysis. Get ready, it's time to take your chance with corporate finance. Here we are in Excel. We have the information on the left-hand side. We're going to put that into the blue area, into the worksheet on the right-hand side. We're going to be thinking about the break-even analysis, break-even in units formula. This is like a core fundamental calculation that we're going to be needing oftentimes when we're projecting out into the future and trying to think about budgeting options. How many units need to be produced in the future? That'll be this break-even point to see how many units we need to produce in order to break even, in order to clear our costs. Now, you might be thinking, well, I don't want to just break even. I want to make a profit. That makes sense. But the break-even point is the starting point that we can then build on and add to then a similar type of formula to think about what type of profit or how much profit we would want. So this is kind of a building block formula. This is a fundamental formula we need to understand. Now, when we think about the break-even point, remember that we got to be breaking out our costs then into variable costs and fixed costs, meaning we're breaking them out not by what they're being used for by function, as is normally the case in a normal income statement, but rather by how they act, how they behave with relations to changes in sales volumes, meaning sales going up and down. So if we categorize our costs by how they behave, it becomes a lot easier for us to do these kind of analysis for the future, projection type of analysis, what if type of analysis. So we want to be able to, as much as possible, and it's not perfect, it's never perfect to know exactly how these costs will behave, but as much as possible, if we can break them into those two categories, either variable or fixed in nature, then makes it a lot easier for us to do projections into the future, starting with our core projection, our baseline projection, and calculation, that being the break-even in units formula that we'll be taking a look at here. So a quick rundown just as a recap. Note that a cost that varies with production means that as production goes up, you're going to have an increase in the total costs, and but the unit cost will remain the same. And the primary item there would be something like the cost of materials. The cost of materials, if we make things, as we produce more things, as sales go up and we have more sales, you would think that the cost of the materials, if we're putting those into the production of the units we're selling, inventory, would go up in relation to the cost of the things we're selling. Meaning that if total sales go up, then the total cost will go up along with it for the materials. However, the unit cost, the cost per unit, will remain the same, because the unit cost we're going to say is the same for each individual unit, if we can break it down to each individual unit. As opposed to something that's a fixed cost, mainly being like the rent would be a good example of fixed cost. Notice as the production level goes up for fixed costs, we have more sales, we sell more things, the rent remains the same. It remains the same up until the point when we need more space, that we got to then get more space, right? But the fixed cost basically remains the same no matter what our sales volume is, as long as it's within the range of our capacity for the building that we have in it. Therefore, as sales volume goes up, the fixed cost does not. It will remain the same. The unit cost, which is a little bit confusing, this is kind of the confusing thing about the fixed cost. The unit cost will actually go down, meaning that if you have more revenue going up, then the cost per unit, if we were trying to come up to a per unit cost for the fixed costs, it will go down. It will cost less fixed costs to produce each unit as we go closer to capacity for the fixed cost. But that's going to be the general kind of idea here. We got to break costs out between variable and fixed costs. Once we do so, then we can do our basic kind of formula, which is going to be taking the fixed cost, this is our break-even formula, and we're going to say that that's going to be the 105. You can imagine the fixed cost, main fixed cost, I would say once again being like the rent. Anything that's like the rent, meaning you got to pay it no matter what happens with the sales volume. Many of the expenses will be that way, right? You're going to have insurance or other types of things that you pay every month. It is what it is. That's the subscription. Salary is going to be that type of way. These are things that aren't going to change as sales volume will go up and down. So we're gonna say that's our starting point, and then we're gonna divide into that the contribution margin per unit, which is known as the sales price minus the variable costs per unit. So let's see what that'll look like. We're gonna then take the contribution margin per unit. Let's do that calculation. Now, this is a new term that we don't really see on normal financial statements because it's more of a kind of a managerial or decision-making type of term, like a financial accounting future calculation type of term that we are going to be using. You don't see this on the income statement because the income statement is breaking down costs by what they're used for, not by the behavior of the cost. We're breaking these down by behavior. So then we're going to take the sales. We'll take the sales price per unit. So this is the unit sales price. It's going to be the $75. That's per unit. And then we got the variable cost per unit. Variable cost per unit is going to be the $42. The $42, I'm going to put an underline here, go into the home tab, the font group, and underlining. And that's going to give us our contribution margin per unit. I'm going to get rid of the colon at the end. I'm going to do some formatting, selecting these three cells, home tab, alignment, increase the indenting. Then I'm going to increase the indenting here a bit more. Home tab, alignment, increase the indenting. Let's do the subtraction here. This will be equal to the 75 sales price minus the 42 for the cost per unit. That brings us down to the $33. So every unit that we sell then, we're going to go away with $33 after the variable costs, those that change with each sales unit. And the most common thing would be things that go into the unit that we make. If we're making things, the materials that go into the unit will be the most common thing. But we could have other variable costs that could be things even like selling costs that might be sales commission and stuff like that. Labor that's hourly and whatnot could go into the unit production, could vary then with the increase and the decrease in the sales volume. So we're going to say then we're coming away with $33 after the variable cost. Let's put the underline there. Then we're going to divide that into the fixed cost. So now we're going to say, all right, this is how many dollars we're coming away with after the variable costs. How many units then do we have to sell in order to cover the fixed cost, like the rent? So if you were thinking about like a basic type of business, if you had like a food truck type of business or something like that, and you're selling hamburgers or something, then you'd say, all right, the variable costs represent the burger that you're making, the meat and whatnot. You can break those down into a per burger cost, right? Now we have a per burger cost that we have, and you can say, okay, that if I have the sales price minus the cost per burger, and say the sales price is $5 and it costs $2, then you're going to say, well, the sales price minus the cost per burger is $3, but then I got to pay for the cart, which, I had to rent or something, for $500, right? Then you can take the 500 divided by the 3 burgers and see how many burgers you got to sell to at least clear the cost of the fixed costs. Same thing here. We're going to say, all right, we're going to sell them for $75, $42 go into the production of the things that we're selling, and any other variable costs, things that change along with the production, that'll give us the $33 per unit. Then the question is, well, how many units do we have to sell to cover the fixed costs, like the rent? How many things do we have to sell to cover the rent? So then we're going to say, all right, that's going to mean that the rent is the $105,000 divided by the 33. That means we got to sell 3,182 of these items in order to cover the costs in total. So you can see how useful that will be for us to think about it in this fashion rather than just grouping all the costs together. If we break them out in this fashion, we can break it out to what we're getting per unit, then divide that into the fixed cost and think about how many units we need to sell. That's the starting point. So then you can start to say, well, what if I want to get a profit of $50,000? Well, then you could say, well, let's take the fixed cost and add the $50,000 profit to it, and you'd have, $155,000 and divide the 33 into that to see how many units we would then need to sell in order to cover the fixed cost plus whatever profit we wanted to be making. Now, this is the core kind of formula. Now, note that some businesses will have greater fixed costs and some will have less fixed costs than others. If you're talking about something like a movie theater or something like that, note that the cost per person per ticket to go into the theater is relatively low once the movie is playing, right? What the big cost is going to be is actually the playing of the movie, the space in the movie, the rental of the building in the movie. So they may have a larger fixed costs and the variable costs per unit, at least per ticket, may be lower. Whereas if you're working with something that's a just-in-time kind of sales system, where you order something and they put it together, just in time, and then they give you the unit, then it may be the case that most of the costs are on a per unit basis, and they may be able to do that with fairly low fixed costs. So some industries are going to have more variable costs. Some industries are going to have more fixed costs, and there's pros and cons to either scenario. So that's going to be some of the things that we will use from a financial standpoint to compare different companies, how they're, what industry they are in, and what the relationship between fixed costs and variable costs and the effect of that relationship will be on things like risk and leverage. Now, what if we were to prove this? We can prove this now, of course. We can say, let's do our income statement. Now, when we start to do our income statement, I'm going to calculate net income, and I'm basically going to do an income statement, but rather than doing a normal income statement, sales minus cost of goods sold, gross profit, minus, operating expenses, so on and so forth, we're going to break it out between what I would call a contribution margin income statement, which is basically breaking out the income statement by activity, behavior of the costs, which again, you will not see if you're outside of the company. If I'm outside of the company, I'm looking at financial statements, they will be not in the format of a contribution margin income statement. You can try to convert them into one, but internally, we may very well and oftentimes will break our information out into a contribution margin type income statement, breaking it out by behavior rather than by what the costs are used for, so that we can do this type of analysis. So it'll look a little bit different, but similar, right? We're going to say, let's calculate the sales. I'm going to say the sales are going to be the sales price per unit times the units sold. So let's pick that up. We're going to say the sales price per unit is going to be $75. We're going to be selling the units that we're selling. We're going to prove this by saying, hey, we're selling this many units that we got to on the break-even analysis. And that's going to give us our sales number. I'm going to go ahead and format this, selecting the sales, home tab, alignment, increase the indenting. I'll increase the indenting of the sales, home tab, alignment, increase indenting. Multiply this out. This is going to be equal to the $75 times the 3,182. Let's put an underline here, go into the home tab, font group, and underline. Then we're going to be picking up the variable costs. So these are the variable costs. Now this is where it might be a little bit different, because you would expect maybe cost of goods sold here, right? We're not doing cost of goods sold here because we're not grouping it by the cost of the inventory we sold, although the variable costs will probably be picking up many of the costs related to inventory if we manufacture inventory, or if we buy and sell inventory, because we'll be picking up materials and typically labor in variable costs. But that's not really why they're here. They're here because they're changing with relation to the production level. So things in selling might be here too, such as sales commission. May be something that we put into variable costs as well. So variable costs, breaking it out by behavior. So what can we say will change with relation to unit sales changing? So variable costs per unit, and then we want the units sold once again. Let's take that from up here. That's going to give us our variable costs total. And also note, when you start to think about this, you'll start to, if this is new, you'll start to see variable costs per unit and variable costs in total. You got to start breaking out the unit when you're talking about units versus the total. Same with the contribution margin. We have the contribution margin per unit, contribution margin total. And oftentimes people will not clearly identify which they are talking about, right? So you got to look at the number. Okay, is this a unit contribution margin you're talking about, or is this the total contribution margin? Meaning, are you talking about the sales price per unit minus the variable cost per unit, or are you talking about the total sales minus the total variable costs? Okay, so then we're going to select these items, go to the home tab, alignment, increase the indenting, then go on down here. We're going to go to the home tab, alignment, increase the indenting. We're going to be picking up our numbers are going to be equal to the $42. $42. Let's make this a little bit larger so we can see the whole name there. And then we're going to be picking up the units sold, which once again is the break-even point, because we're trying to prove that it's going to come out to 0 here. The break-even, this bottom line number is going to come out to 0. And then we have the 42 times the units sold. Let's put an underline here, go into the home tab, font group, and underline. And then that's going to give us our contribution margin. So this is going to be our contribution margin. And you might think this is kind of like where you would expect gross profit to be, because you would expect on a normal income statement, sales minus cost of goods sold. But now we have sales minus variable costs, meaning now we have contribution margin. That should look funny if you've never worked with these kind of this kind of format before, because it's not what you see on external financial statement. That's not what the bank wants to see typically, but that's what we want to see internally, or break down for this type of analysis, for this type of projection analysis into the future. So then we're going to go to the Home tab font group, and we'll put the underline here, and then we're going to have the fixed costs. So fixed costs we're going to put down here. These are all the costs that do not change relative to sales, and they of course line up to that 105,000. And that means that the net income will be equal to 105 minus 105, or 0. Why? Because we broke even. Because that's how many units we need to do the break even point. So we're going to go to the Home tab font group and put the double underline here. Let's put the double underline here. Home tab font group, double underline. So if you just break these two out, you can see why this works. You're going to say, all right, I'm trying to see how many units I got to sell to break even, to then think about how many units I might be able to do to make a profit. So I'm going to take the sales price per unit minus variable cost per unit. That means I'm coming up with 33 per unit. Then I got to pay like the fixed cost, which includes, say, the rent. So I'm going to divide the 33 into the fixed cost. That means I got to sell 3,182 units. Well, let's prove that. Well, if I sell 382 units, 3,182 units at $75, that's going to give us the sales price here. And if I take the variable costs, which were that 42 times those same units, that gives us a total variable cost here, which then if I subtract those out, gives me a contribution margin, what we come away with, sales minus the variable cost, this in total, contribution margin, rather than the contribution margin per unit, right? And then, and also note you can get to this number, which is useful in book problems and in practice from time to time, by taking the contribution margin per unit times the number of units. That's going to give you that 105 as well. Let's just keep that there. And then that of course will match the fixed costs that we will have, because that's what we divided the contribution margin into to get to that number of units, which means that the net income is 0. That's our starting point. So once we know the starting point, then we could start to think of how many units we need to sell to make the profit that we're aiming at.